So far in this series, we've covered investing strategies that are meant to perform reasonably well, though maybe never elite, in just about any economic situation in the form of the permanent portfolio. We've also covered strategies that seek long-term growth, even if it means taking on more short-term risk in the form of the all-stock portfolio. And last time we covered perhaps the most common investing strategy, the classic 60-40 portfolio. This week we'll be looking at the no-brainer portfolio, which is an investing strategy that seeks to produce superior returns to all of the previous strategies on a risk-adjusted basis. As always, we'll be examining how this strategy stacks up to the others in terms of long-term growth, managing economic downturns, and achieving financial independence. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. The no-brainer portfolio was created by a neurologist named William Bernstein, author of books such as The Intelligent Asset Allocator, The 4 Pillars of Investing, and others. The strategy has you equally splitting up your investments into 4 different categories: large cap US stocks, small cap US stocks, international stocks, and short-term bonds. Its primary goal, at least as far as I can tell, is to achieve higher risk-adjusted returns than something like the S&P 500 through better diversification. This means that it may not necessarily be striving to perform better during any specific economic situation, such as increasing levels of inflation, and it may not be looking to maximize growth or safe withdrawal rates in retirement. It may not even be looking to minimize the downside risk or recovery timelines associated with economic crashes. It may do some of those things, but they would be an added bonus. The main goal appears to be that when you take a step back and look at the big picture, are you getting the most bang for your risk-taking buck? With that being said, let's start by analyzing the historical long-term returns of the strategy. As usual, to analyze the returns, we'll be looking at a few different metrics. The long-term 40-year inflation-adjusted returns from every year starting from 1970 through the end of 2019, since that's the first and last years for which I have completed data on all of the assets involved in the strategy at the time of the recording. That is quite a different time frame than we've been using so far in this series, so at the end of the video, I'll also give an update on how the other strategies we've already covered would have performed during that stretch so we can have a more apples-to-apples comparison. We'll also be taking a look at how many times the portfolio lost money and how severe those losses were. But since this strategy primarily seeks to achieve better risk-adjusted returns, we'll also be adding in some new volatility metrics that we haven't been using to this point in the series, such as the SHARPE and SORTINO ratios. The SHARPE ratio will give us a better idea of the risk-adjusted returns over various time periods, and the SORTINO ratio will do the same, but will only be concerned with the downside volatility, since that's what most investors are really trying to minimize. Finally, we'll touch on how dependable or trustworthy the strategy is by examining how sensitive those returns we're seeing are to when you decide to start investing. So based on the data I have since 1970, the average 40-year inflation-adjusted return for the no-brainer portfolio is about 6.2% per year. Its worst case was around 5.2% per year starting in 1973, and its best case was 7.2% per year starting in 1975. That suggests that a $10,000 investment would grow to, on average, about $111,000 over the course of 40 years after adjusting for inflation. At worst, you're looking at about $76,000, and at best, a little over $161,000. Again, due to the fact that we're using different time frames than normal, we'll save the comparisons to the other strategies for the end of the video. For now, let's move on to the volatility metrics. The average standard deviation of returns for the no-brainer strategy was 12.9%. which means that in any given year, we can expect that the majority of our returns will fall somewhere between negative 6.7% and 19.1% with this strategy. And just like with any other strategy, there will occasionally be a few exceptions where the returns fall outside of the expected range, for better or worse. Looking at the individual returns of each year on our return diversity chart, we see that roughly 68% of them, or 34 out of the 50 cases, do fall within our expected range. There was a total of 14 years out of a possible 50 where the portfolio failed to keep pace with inflation in this sample. That's a loss frequency of around 28%. Thankfully, those down years were recovered from quickly, as there was not a single 10-year stretch during this 50-year span where the returns failed to keep pace with inflation, which is awesome to see. Next, let's talk about start date sensitivity. Start date sensitivity, at least as we've been measuring it in this series, takes a look at the rolling returns of the 10 years prior to each initial investment date and compares it to the rolling 10-year returns of the following 10 years to see how big of a difference there is between the two. It's a good way to get an idea of how trustworthy an investment strategy has been historically. And ideally, we want our total start date sensitivity, measured here by the difference between the largest underperforming and largest overperforming decade, as low as possible. The no-brainer strategy clocks in with a total start date sensitivity of 18.2%. The largest overperformance was 10.1% per year, which took place from 1982 to 92, where the no-brainer strategy had average inflation-adjusted returns of 10.9% per year, beating out the returns from 1972 to 82 of 0.8% per year. So it is definitely worth noting that while it technically didn't lose money during any of the 10 years encompassing the high inflation of the 1970s, it didn't do much better than just keeping up with that inflation either. Still, that's better than most of the other strategies we've been looking at have done, so it's worth noting. The largest underperformance was 8.1% per year, when the returns from 1999 to 2009 failed to match the returns produced from 1989 to 1999. But since this strategy is so focused on trying to achieve higher long-term risk-adjusted returns than something like the S&P 500 through superior diversification, I wanted to look at a couple other metrics before moving on to our crash analysis. So let's talk about the SHARPE and SORTINO ratios. The SHARPE ratio is probably the most well-known way to measure risk-adjusted returns. It measures the risk-adjusted return of an investment or portfolio by taking the average return of the portfolio over a period of time, in this case we're using 40-year stretches since 1970, subtracting a risk-free rate, which is often the expected rate of return of a treasury bill or some other cash equivalent. I'll be using treasury bills to find the risk-free rate today, and then dividing the result by the standard deviation of the portfolio. So in our case, we have an average inflation-adjusted return of about 6.2% per year. The average 40-year inflation-adjusted return of T-bills during this time was 0.8% per year, so we'll use that as our risk-free rate. And of course, our standard deviation was 12.9%. So 6.2% minus 0.8% gives us 5.4% average returns over the risk-free rate. Divide that by 12.9% and we get a SHARPE ratio of around 0.42. Anything above 0 suggests that an investment is earning some additional returns for every additional unit of risk it takes on, which is what we want to see. And the higher the SHARPE ratio is, the more return you're getting for every additional unit of risk you're taking on. The SORTINO ratio is a variation on the SHARPE ratio, and it measures the excess returns of an investment per additional unit of downside risk you take on. You still subtract the risk-free rate, or some other minimum acceptable rate of return you want to specify, from the portfolio's average return, and then divide it by a standard deviation. But unlike the SHARPE ratio, the SORTINO ratio's version of standard deviation is only concerned with volatility during downturns. After all, most investors would be perfectly okay with standard deviations of 30% if their average returns were 40 or 50%. Sure, on some bad years they may only make 10 or 20%, but that's still a positive return. The standard deviation for the no-brainer strategy under the SORTINO ratio during this time frame would be 6.6%. So when we plug the numbers into the equation, we get a ratio of 0.82. For context, a 100% large-cap blend stock portfolio, similar to what the S&P 500 would have had a SHARPE and SORTINO ratio of 0.33 and 0.63 respectively during this time. So the no-brainer strategy appears to have done its job of getting higher risk-adjusted returns than something like the S&P 500, at least based on these metrics, even if its overall returns and growth is a bit lower. But that just about wraps up our analysis of the strategy's returns. Now let's move on to our analysis of crashes. A crash analysis is important to do for any investing strategy you're looking at because it's important to know that if you're going to put your life savings into something, you'll be able to weather the storms when they come, both financially and otherwise. In these videos, we always look at a few different metrics when analyzing crashes. They are how deep the crash got at its worst, how quickly the strategy recovers from the crash, and the Ulcer Index, which largely combines the other two metrics into a single number. The deepest crash for the no-brainer strategy, and the longest one for that matter, was in the mid to late 1970s, just like it was for the classic 60-40 strategy. From the highs set in 1973, the strategy would fall 41% when adjusting for inflation by 1975, before beginning a slow climb back up to set new highs in 1981. So it was down for about 7 years. And while it did fall further than the 60-40 strategy, it also recovered a full 3 years faster. Now remember, inflation was kind of nuts at this time, like I discussed in that classic 60-40 video, so much of the inflation-adjusted fall is the inflation itself, as opposed to the actual price of the investments cratering like we saw with stocks during the Great Depression. As we saw in the video on the classic 60-40 strategy, inflation jumped by about 22% from 1973 to 1975. So of the 41% that the no-brainer strategy fell, only about 19% of it was actual price declines. The rest was inflation. And as I said in the video on the classic 60-40 strategy, inflation hits different people and different lifestyles differently. So it's certainly something to keep in mind as we go forward with this series. But anyway, the ALSR index during this time rose to as high as 1.6, with an average of about 0.5, both of which were much better than the high of 3.1 and average of 1.4 that we would have seen from an all-stock strategy during this time. So once again, we're seeing that even from an experiential perspective, the no-brainer strategy is achieving its primary goal fairly well during this stretch of years. With that being said, let's move on to examining the strategy in regards to financial independence. Historically speaking, the no-brainer strategy would have maintained minimum safe withdrawal rates of 4.79% over any 30-year stretch, 4.52% over any 40-year stretch, and 4.61% over the 150-year stretch that we had from 1970 to 2019. The worst year to retire for this strategy was 1973, as that's when the 30 and 40-year minimums were set. The 50-year minimum, of course, was set in 1970 because that's the only 50-year period we have to go off of. And I should note that, again, as usual, due to the varying nature of individual expense ratios and tax situations, neither has been considered in these withdrawal rates. The median rates were a bit higher at 7.75%, 6.90%, and again 4.61% for the 30, 40, and 50-year scenarios respectively. The maximum rates for the 30 and 40-year scenarios were 9.25%, set in 1982, and 8.41% set in 1975. The strategy would have maintained a minimum perpetual withdrawal rate of 4.03%. And as usual, perpetual withdrawal rates is being defined as the highest amount of money you could have withdrawn while still maintaining your original inflation-adjusted principal all the way through to the end of the dataset. The accumulation phase of financial independence is where you're still putting money away for your future. The primary metrics here are, as always, the percentage of our income that we're saving, how our expenses change over time, how long we plan to be retired, and how long it'll take us to reach financial independence based on that information, and the performance of our investing strategy. Assuming that our expenses change at the same rate as inflation, which, as we covered, isn't always the case, but it's the assumption we're making for this model, and we were planning on a 30-year retirement and saved either 15 or 30% of our income using the no-brainer strategy, we would have never reached financial independence, which is not great. With a 50% savings rate, a hypothetical investor would have reached financial independence in 25 of the 50 scenarios. On average, achieving FI with this strategy and at this level of savings took about 30 years. The fastest would have been 25 years starting in 1982, and the slowest 37 years starting in 1970. And finally, with an absolutely crazy 70% savings rate, a hypothetical investor would have reached financial independence in 40 of the 50 scenarios. On average, achieving FI with this strategy and at this level of savings took about 13 years, with the fastest being 10 years starting in 1990 or 2008, and the slowest being 19 years starting in 1970. So on your screen now, you'll see updated return figures for the all-stock, classic 60/40, and permanent portfolios since 1970. What we notice is that even when comparing things over the last 50 years, the no-brainer strategy holds up pretty well in terms of overall returns. Its average 40-year inflation-adjusted return of 6.2% per year is second only to the all-stock portfolio's 6.6%. Its median and max returns also come in second behind the all-stock strategy, and its minimum 40-year inflation-adjusted return of 5.2% actually tops the list. Its start date sensitivity of 18.2% easily beats out the all-stock strategy's 34.4%, and even manages to edge out the classic 60/40 strategy for a second-place finish, suggesting that it's a reasonably dependable investing strategy, at least compared to this field. Its volatility metrics weren't quite as strong, but were still respectable, and leaps and bounds ahead of the all-stock strategy. It lost money in 14 of the 50 years, which tied it with the classic 60/40 and permanent portfolio for first place. Its standard deviation of 12.9% and maximum crash depth of 41.2% came in third behind those same strategies, so there definitely was a noticeable difference between the three here. Its average ALSR index of 0.5 came in second behind the permanent portfolio, which posted a frankly astonishing 0.1 during this stretch. However, the no-brainer strategy showed better than expected resiliency with its longest crash lasting just 7 years, good for second place behind the permanent portfolio, which never spent more than 5 years recovering from a single crash during this time frame. As far as investing for financial independence goes, the no-brainer strategy performed fairly well. It had higher 30, 40, and 50-year safe withdrawal rates than the all-stock strategy and the classic 60/40 strategy. And it had the highest perpetual withdrawal rate among the strategies we've covered so far during that stretch, and even managed to beat out the permanent portfolio's 40-year safe withdrawal rate, though it did lag behind the permanent portfolio in terms of 30 and 50-year safe withdrawal rates. Which is actually an interesting thing to note, because as we saw in the video covering the permanent portfolio, maintaining a high safe withdrawal rate was not its strong suit. The main reason we're seeing a difference in the outcomes here is that we're mostly focused on a time period where the price of gold was not artificially fixed. To give you an idea on how that affects things, the price of gold was artificially kept around $35 for a good 3 decades or so, until around the time the US went off the gold standard, at which point it promptly quintupled in price over a handful of years. And the permanent portfolio had a fairly sizable amount of gold in its makeup. So what we had was a 3-decade stretch where a good portion of an investor's money was being tied up in an asset that, on paper anyway, wasn't appreciating. And that can be quite a drag on returns and sustainability over the long run. But getting back to the no-brainer strategy, it also held up reasonably well in the accumulation phase. Sure, it didn't manage to achieve financial independence using the assumptions we laid out with either a 15 or 30% savings rate, which is not good, but then neither did the classic 60-40 strategy or the permanent portfolio. And under the 50 and 70% savings rate scenarios, it held up about as well as the classic 60-40 strategy did. So that's the no-brainer strategy. In the end, it's difficult to get a full overview of it, given that I don't have data for everything going back to before the Great Depression, but at least based on the last 50 years of information that I do have available to me, it does seem to achieve its primary goal of achieving higher risk-adjusted returns than your typical S&P 500 index would. It accomplished this primarily by being slightly more dependable and resilient overall, with lower maximum crash depths and crash durations, and still maintaining a solid, if slightly lower level of overall returns. But what did you think of the no-brainer strategy? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.